Welcome back to Turpentine VC, the podcast where we discuss the art and science of building successful venture firms, VC to VC. This week, we're sharing my live interview with Sarah Tavel and Erik Vishria, two of Benchmark's general partners. We talk about Benchmark's disciplined approach to venture capital, their minimalistic business model, investment philosophy, and discuss why true moats are often more complex than they appear. Since this was recorded in November 2023, Benchmark has announced a $425 million fund in 2024. Please enjoy this rare glimpse of how Benchmark operates. Sarah, Erik, welcome to the podcast.
Thank you for having us.
Thank you.
Yeah. So we're here today to announce some big news: Benchmark growth, seed, accelerator, debt, credit.
Yes.
You guys have been holding back for 20 years.
But this is the moment for us to talk about it.
Yeah. And the investment banking division. We're all
wealth management.
We're actually going public. This is the next step.
International.
What took you guys so long?
When other people are zigging, we're zagging. So
people are consolidating. And now it's time to go big. Speaking of, in this podcast, we've been covering the history of venture capital, looking through a few different firms: Sequoia, Kleiner, Andreessen, Benchmark. When you think of Benchmark in the context of venture capital, in the context of the history of venture capital, where does it fit? Like, how do you think about kind of the era in which Benchmark came in relative to the era in which other firms came in?
The history is super interesting and I think it's actually reflected in the culture of various firms. If you think about it, a lot of the original venture capital was when semiconductors were huge, and there was a lot of innovation happening there at the very foundational level. So if you think of Sequoia, for example, that's a semiconductor era firm founded in the 70s. Benchmark is distinctly an internet era firm founded in 1995. And then you could kind of fast forward, and Andreessen's mobile era firm, founded in 2009 or 2010 or whatever. And so they're all kind of reflective of that, of those eras in terms of, you can kind of think of what did it take to be really successful in those businesses? And to be really successful in a semiconductor business, you need to be very operationally rigorous, and you need to watch every penny, and you need to be extremely financially oriented. And to be successful, I think in the internet era, it was a lot more forgiving that way. Financially, it's a lot more forgiving. And so you had a lot more flexibility to let founders dream, maybe. And you don't have to watch every penny, but you do have to hyper focus on growth. But, it's a 1995 era firm. So we're coming up on 30 years. And I think a lot of those attributes still exist today.
Yeah.
I might add a couple other attributes that you just make me think of, which is firms, even, you see this in startups, you set the bones of a company so early on, the culture, the orientation, and then even when it starts as a couple people and it expands to thousands, you still see that early DNA, and it's very true. And then I also think about the vintage that a firm has started, right? Benchmark was started internet era, but before was the beginning, where it really expanded. And then, the firm was started then as, if you are thinking about that early stage founder who is going to be going on a decade-long journey, what's the firm that you would design from that person's perspective of bringing on a partner and work backwards from there? And then when the craziness happened of, the internet bubble, and after that, Benchmark expanded, as many do during times like those types of bull runs, and then kind of realized, came back to the knitting. And I think about some of the more recent firms too, where the firm that starts today is going to be very different than the firm that was started 10 years ago, and very different than the firm that was started 25 years ago, just because of the capital environment too. And so it'll be interesting to reflect on that 10 years from now and see what's emerged.
Yeah. Some firms that have aggregated a ton of capital over the last decade, it'll be interesting to see if they too sort of consolidate or narrow, or if they just keep, going to the moon. But you guys have transitioned very well to next eras. When you look at the most iconic mobile companies, people think Uber, Snap, Instagram, Tinder. I'm sure there are others that you guys have done.
So what do you think about is like the benchmark DNA that has enabled you to succeed in multiple areas?
I mean, when I think about, there's a couple things that come to mind for me. Like, of course, there's just the endless curiosity and that I think we all try to nurture in each other, and we have habits as a firm that are ingrained in our culture that are all about nurturing that curiosity and just not constraining it in any way. Like our Monday meetings, as an example, there's no agenda. It's not like this is the time to talk about new projects. This is the time to talk about existing portfolio. It's just this open-ended thing that lets us, start the strangest conversations sometimes, but are all about pulling the thread of someone's curiosity, expanding it, and see where that goes. And then the second thing that I really think about is just that the joy that we all feel partnering with founders. And there's nothing like that work. I met with a founder the other day, and he's like, "Oh, you must be so exhausted. You're just hearing pitches all day." And I was like, that is not my experience at all. That's not our experience at all. Like every time we talk to a founder, it's just the delight in hearing the future that they see and imagining together, like how that journey is going to look. And I think we all feel that joy, and then it really manifests in the type of partnership that we want to have with the founders we work with, which is like each of us making one or two investments really a year and having the deep commitment when we do partner of what that work looks like, and doing the shoulder-to-shoulder stuff of recruiting, of company building, and being really enmeshed in that like whole organization so that we can be the best partner to the founder. I think that's one of the biggest things that you feel, at least in our partnership meeting, when we're talking about company building and the companies that we work with and the founders that we want to partner with, is that joy and delight in that partnership.
What makes benchmark is the 5 equal partners, or now 6?
Now 6.
Now 6.
As of like a month ago.
Yeah, which we'll talk about. No platform team, and just consistent fund sizes and focus, fund after fund, at a time where lots of other firms have aggregated, lots more capital, lots more practices, or firm products. You guys had a stint where you sort of went bigger. Talk about what you learned from that, and do you think that just wasn't the right fit for you, or what the firm learned from that? Because I'm curious, given all the opportunities, even your success has enabled you, what would need to change in order for you guys to say, hey, actually, we should do something a little bit different, even though we've been doing the same thing for such a long time?
I think we're always asking that question, actually, and we think of every new partner as an opportunity to refound the firm. And we think of it as a refounding of Benchmark. Every new partner is an opportunity to do that. And so I think, you always have to be questioning your assumptions, and are you doing the right thing, and everything else. The expansion of Benchmark that had happened in the early OOs was well before Sarah or I were there, and even the expansion and contraction happened before. But if you talk to the founders, it kind of makes sense. Like the firm was founded on this idea of an equal partnership, which is like it was originally 5. They came in, $1 comes in, they split it 5 ways. Doesn't matter who has the board seat. Everyone owns the management company equally.
Yeah.
Everyone, has equal economics. There's a lot of good things with that. It gives you a lot of flexibility in terms of who you can bring on, because you're cutting someone in equally in economics. And so it's lucrative to the unproven venture capitalist. It kind of eliminates internal politics, because you're not jockeying for additional economics or more control or whatever, or trying to get your deal through, because everyone has equal skin in the game, so to speak. It's 5, 6 people, like, okay, you can have a lot of trust and affection for a few people, and you can work together really well. But if you can't have 15 equal partners. Like, humans need management at some level of scale. And so it doesn't scale. Like, it's the reality of it. And I think one of the things that happened in the expansion is that just kind of showed. Which is like, hey, the founders would say they were spending a bunch of time on stuff they like expressly did not want to do, which was managing a firm, We spend almost no energy managing the firm. We like literally spend no energy managing the firm.
laughable.
It's horrific how poor we are at managing the firm, actually, because we're spending 100% of our time, with entrepreneurs, looking for the next great company, working with the companies that we are already committed to, and that's where all our time goes. We spend almost no time fundraising. Like literally no time fundraising. And so like a lot of these other aspects of the job, we just don't spend any time on. And so I think that's one of the advantages, but it also has an express constraint, which is it doesn't scale particularly well.
Hey, we'll continue our interview in a moment after a word from our sponsors. Even if you think it's a bit overhyped, AI is suddenly everywhere, from self-driving cars to molecular medicine to business efficiency. If it's not in your industry yet, it's coming fast. But AI needs a lot of speed and computing power. So how do you compete without costs spiraling out of control? Time to upgrade to the next generation of the cloud. Oracle Cloud Infrastructure, or OCI. OCI is a blazing fast and secure platform for your infrastructure, database, application development, plus all your AI and machine learning workloads. OCI costs 50% less for compute and 80% less for networking. So you're saving a pile of money. Thousands of businesses have already upgraded to OCI, including Vodafone, Thomson Reuters, and Suno AI. Right now, Oracle is offering to cut your current cloud bill in half if you move to OCI for new US customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies for this special offer at oracle.com/turpentine. That's oracle.com/turpentine. Hey everyone, Erik here. In this environment, founders need to become profitable faster and do more with smaller teams, especially when it comes to engineering. That's why Sean Lenihan started Squad, a specialized global talent firm for top engineers that will seamlessly integrate with your org. Squad offers rigorously vetted top 1% talent that will actually work hard for you every day. Their engineers work in your time zone, follow your processes, and use your tools. Squad has front-end engineers excelling in TypeScript, React, and Next.js ready to onboard to your team today. For backend, Squad engineers are experts at Node.js, Python, Java, and a range of other languages and frameworks. While it may cost more than the freelancer on Upwork billing you for 40 hours, but working only 2, Squad offers premium quality at a fraction of the typical cost, without the headache of assessing for skills and culture fit. Squad takes care of sourcing, legal compliance, and local HR for global talent. Increase your velocity without amping up burn. Visit choosesquad.com and mention Turpentine to skip the waitlist.
And is it fair to say that the best firms that are scaling venture, that they might make more cash, but they will just make lower multiples? How do you think about like the trade-offs?
I don't know. I haven't really thought about their business model that much, to be honest with you. I think they have put in structures in place that are probably more hierarchical, that allow look more like companies.
Yeah.
Than they do like firms, and that they're hierarchical, and they're CEOs, and they're managing partners, and they're people who have decision-making authority and whatnot, which is great. Like, I think it takes all kinds, but it's definitely different. We would utterly fail at that, and we're not well equipped to do that.
And I'd say certainly like our aspiration is to set the high watermark on multiples. Benchmark has a history of having done that. We wake up every day paranoid that how do we out hustle, outwork, whoever it is that we need to do so that we can be there in front of the founder who's going to build that next iconic company. And that's, I think, the paranoia we wake up with every day is making sure that we're going to be in the room.
Yeah. It seems like the flood of capital in the past decade is challenging for your strategy because prices go up, these undisciplined firms perhaps. And so for the same deals, you either don't do it because the price comes up or you just have to pay a higher price. Feel free to, how would you respond to that characterization, or how do you guys think about macro as it affects your business?
I'd worry about that a lot less, actually. It's kind of interesting. Sure, there's inflation. Inflation's real. Our initial check size, I'm sure, has gone up, and so forth. But the reality is outcomes have gotten bigger.
Yeah.
So, from a multiple perspective, I don't know that it is as constraining as it might seem on the surface to do that. I think we can still generate, 20, 50, 100x outcomes for our investors, and and have those runaway companies. The key is being with the runaway companies.
Yeah.
I think one of the really special things that makes Benchmark is that the level of commitment that we have to have internally in our own minds to work with a company. We were talking about a company this week, actually literally this week, that's like very exciting and a really great entrepreneur in a cool space, but maybe a space that we know less about. One of our partners, Miles, is just like, if we were in a place where we would do a participatory check, like this would be one that but we don't do that. Yeah. And so because we don't do that, if there is a company, the commitment required, forget about the money, but just like mentally, you're kind of saying like, I'm going to work on this for the next decade.
Yeah.
And I want to work with this person for the next decade and like really work with them. And it's going to be one of the, 15 shots I take over a course of a decade.
Yeah.
Like that's a pretty like reasonably high standard that you're holding yourself to in terms of the conviction that is required. And so I think that's where it kind of manifests.
Yeah.
Yeah. So it's you two, it's Chathan, it's Miles, it's Peter,
Yes.
and it's your newest partner,
Victor.
And this is the third era of Benchmark. Talk about the other two eras and how this era compares.
So I'd say like, how does it compare as maybe I'll work backwards is I think it's startlingly similar.
Yeah.
It's a small group of people who like each other and like to work together and call each other and talk to each other often. We have a very like pass the ball mentality. So, Sarah sees a company that she thinks is interesting. While she starts to do work on it, she's very likely to pass it to another partner to meet and engage with, and start pulling up questions and diligence and everything else. It's a very kind of collaborative culture that way. The group has a lot of fun together. And I think the esprit de corps of that yields better outcomes. Like just, you're talking about how to help help an entrepreneur like work through something. And then you're kind of pulling on all these stories continuously. Mm-hmm. And then, the history of the firm's kind of interesting because the founders, to me, the biggest leap that the founders made wasn't founding it equally, which I think you can say like founding a firm as equal partners was like, how do you cut it up? Okay, like great. But they had tremendous success right out of the gates with Benchmark One, with eBay and Ariba, and many others. And the big leap, I think, was the first next partner that they hired and bringing that person in. So they had built all this brand equity. They had had generated returns. They had done the initial LP raise, which wasn't easy actually for Benchmark. It wasn't hard, but it wasn't easy. And then they brought that next person in as an equal partner. And that, to me, was the moment that kind of set the tradition for the go forward. And it's something that everyone here is always super conscious of, even when you're bringing on a brand new person. When I came on, I had no investing experience, like zero, literally none. And, Victor, who just came on, was the CEO of a company, Wildlife Studios, a gaming company that he scaled from zero to hundreds of millions of revenue. And he has zero investing experience, right? But he's like hungry and curious. And so I think those are the parts that are just startlingly similar.
How do you think about partnership construction, right? Because you mentioned you had no investment experience, your newest partner had no investment experience. Sarah had a bunch of investment experience as well as some operating experience. Mm-hmm. How do you think about, before you just recruited Victor, like who's someone who we need to add to the team, or what is sort of the right combination of skill sets and personalities that makes it a really strong partnership?
I mean, it's something that we're very intentional and thoughtful about, because I think one of the things that you probably are hearing from Erik is like, yes, the job is an individual sport, but there are moments when you come together as a group where you really want to construct a way of working together, a partnership where in that critical moment, and there are some really critical moments that happen in venture, the moment of deciding, the moment of winning, and then of course supporting the company during some really important, crucial moments. Those moments are when we come together and really believe that the firm is at its best self because we get to be, larger than the sum of the parts, basically. And so when we think about then those moments, the sourcing, the deciding, closing, supporting, and then, finally exiting, and you think about on the sourcing side, on the kind of top of funnel, like, well, where do we not have a lot of exposure right now as a group? You think about the deciding part, like how is somebody's perspective going to come to the table and bring, make us all better? Maybe somebody spikes. We all have different ways in which we spike. So does somebody spike in business model analysis and in kind of the people relationships and in the empathy for the founder, whatever it might be. And then you kind of think through that all the way down. So you have like a little bit of context awareness almost when we're having these conversations. And then ultimately, in the same way that it's a bit falling in love with a founder and a company, when we meet it, there's something that ends up just feeling right when we meet somebody and develop a relationship with them. After me, there was Chethan, whom Peter was on the board of Elastic with. Miles was on the board of Benchling with Erik and super great with me. Victor is the CEO of a benchmark company. And so we got to see him through a few years of him being the operator of an investment of ours. And so we get these moments of, a moment that you lead up to where you make a decision because you've fallen in love, and it has the depth of relationship usually, and also that context awareness.
And so is it more bottoms up, hey, we just have to have this person, or is it somewhat tops down of, hey, we're weak in this network area or weak in this sector, and we're comparing, let's say, Victor with other people who are kind of
it's there's no like one way, but it has these elements. It's kind of like, people ask, oh, are you roadmap investors? Are you thesis investors? And I would say like some of us will develop a thesis, and certainly we'll see like an area that we believe is coming together so we can, nurture a prepared mind. And then you just meet a founder and you didn't expect to be excited about that area or company, but they say something and you just see something you can't unsee.
Yeah.
And it's a similar dynamic.
So you guys are poachers. You're gifted poachers. As investors, you mentioned, Victor, you said CEO, Miles was at Thrive, Chethan was at NEA, you were at Greylock. So you just happen to work with these investors like, they would be even better at benchmark. Obviously, you have a better offer than any other firm, given how your firm's structured. But what's the process of like getting to conviction and sort of poaching? How do you guys think about it?
It's long and it's long and tortured and windy. It's such an organic process because it's such a commitment, right? Something we bring on a new partner. I think when I joined, 6 years had gone by between Matt. Matt was before me, and then might have been even closer to like six or 7 years, like between Matt joining and me joining.
So you were the bridge between the third era.
But I think the beginning of the third generation maybe, and it's just an organic, long process.
Are you deliberately recruiting, or like
we're always recruiting?
Okay.
We're always recruiting. We spend time on it weekly, really. And part of it is like, this is where it's kind of amorphous and weird, is like, you're not recruiting to say like, wow, we need an enterprise SaaS infrastructure investor at this level. Like, it's not anywhere close to that rigorous, right? It's that part of the job is perpetually meeting amazing people. And so you're kind of constantly trying to meet great people in the industry and super smart up and comers. Like, we spend a lot of time with, 20 to 30-year-olds who are proving themselves and breaking out and making a name for themselves or building a reputation that of having huge impact and being really savvy. And so we're kind of constantly trying to meet those people. And then every once in a while, you'll have a conversation with the CEO or with a fellow investor or with an entrepreneur that makes you think like, the person might be really good, and would fit right in and add dimensions to us, but relate and would be a good cultural fit. And let's explore that further. And, and then I'll be like, hey, Sarah, I met this person. Yeah. It tickled my fancy. Like, let's meet again. And so it's it's pretty organic that way in terms of the process. It takes a lot of time, but it's really rewarding.
our friend Scott Belsky, who worked with you guys for a few years and remains good friends, of course, one thing that was surprising to him in a good way about his time at Benchmark is not just that you guys spend time talking about products and founders and spaces, but also that there was this kind of sophistication about what's happening more macro, what's happening in economy, what's happening in finance. And kind of a funny analogy I'll make is this. Sometimes I see like some war veteran complaining about the direction the country has gone. Or when I talk to older venture capitalists and they look at the past decade of venture, they're like, I can't believe it's been like this, because you haven't been rewarded for playing the right way. And many people have been, I mean, many people have lost for playing the wrong way, but many people have also been rewarded for playing, I don't say the wrong way, but a little fast and loose, or a little bit just not super, fundamentals by the book. And so it must have been challenging for you guys, or even just the past generation, being so fundamental and by the book, or maybe having to stretch at certain times in an era where it was more chaotic.
You have to play the game on the field.
Yeah.
But at the same time, it's really hard to time these bubbles. I think one grounding thing that's really helpful, I think anybody, it doesn't matter if you're an athlete or a musician or an executive or a venture capitalist or an engineer, you do your best work when you're doing something you love to do. Yeah. Like if you love it, like really love it, love the job, love what you're building, what you're doing, the people you're working with, you'll do your best work. And I think that resolves a lot of problems, right? Which is like, in the sense that if you're like, I don't want to speculate. Yeah. Like it's not in my nature. It's not fun for me, because I get value. I get value and satisfaction looking at like a durable company that is compounding year after year. Yeah. And I know that 10 years from now, it is still going to be here, and it's going to be 5 times the size, and making an impact to their customers and to their employees and to their investors. And I get a lot of satisfaction from that. I don't get a lot of satisfaction from like, winning a hand at a casino. Yeah. Like it doesn't do anything for me in the same way. But you're definitely right. Like in the last several years, people have made a lot of money doing that and speculating or momentum investing or whatever. And that's fabulous. Like I think that, it's great. It's great that they've been able to do that. But I don't know that we get a lot of satisfaction from that and a lot of joy. And so by focusing on what you love and like that part, and just the great entrepreneur with a great idea at a special moment in time, I think it solves a lot of the FOMO.
I agree with that. And like what I'd add is, actually, when we look at our investment pace, and I think it was 2020, 2021, it was historically slower. Yeah. And it's because we value so deeply the depth of relationship that we form with the founders that we end up backing. And what you felt in that era was this, Zoom screen, it was just like the founder, like it was just like we were another face. And every time you would have a first call with a founder for Zoom, we have 6 term sheets, and I'm happy for them. But like, what are they looking for? And it just became a little bit this optimization that things were just moving so quickly all the time. And it wasn't that depth of relationship that we value and is what brings us the joy in the work that we do of partnering over these good times and bad times with companies that all inevitably go through, especially now. I mean, holy cow, things just thrash all the time. And so the person you have in your corner, I think, on the board is more important now than it probably has been in any of the prior eras. Like that just wasn't as much of a fit for us. Yeah. And then I look at this year, and we're actually on pace for making the most new investments in a year than we have been for 10 years. Wow. And it's just because like now it's back. I think there's a couple things, which is like, one, you just think about the last few years. It has been so hard to be a founder, right? Like you've gone through these incredible moments of thrash. COVID's behind us, but then you have, the interest rates changing, what happens there. You have Silicon Valley Bank and what happens there, and these like crazy weekend where everybody was wondering how they're going to make payroll. And these things happen now that no matter what size company you are, you're going to have to deal with these huge systemic shocks. Yeah. And I think that makes founders care and really value so much more, not the firm, but who that person is that you're going to be partnering with. And so like that's like number one, where like people care now more than ever, not more than ever, but certainly more than the last 10 years of who that partner is that you're choosing. And I hear that a lot with the founders that I meet every day. And the second thing is that there's a little bit of like, we're not in that craziness of having to make these very fast decisions. And then you have the founders who did make those decisions and warn other founders not to do it, to like really get to know the partner that you're having on your board. And I think those two things coming together, and of course, so many of the interesting trends that are happening in the world of technology has meant that we just feel like this is the type of time that we love to make new commitments.
It feels like the last few years there was a lack of discipline between and the relationship between investor and founders. Maybe investors were a bit too submissive. Founders were raising all these crazy rounds, et cetera. And now is a return back to basics. I'm curious how you guys think about today, sort of the proper pushback between, in the investor founder dynamic.
I think that in any relationship like that, where you're trying to create something or build something, you need some tension, right? Like if you think about like engineers working with product managers and designers, like you need push and pull, like you need constraints, like you need it to go back and forth. And through that tension, you get better results, right? And at times it swings too far one way or too far the other way, right? Like I think one of the challenges, for example, would be with the East Coast venture capitalists or the European venture capitalists. Like the financing for tech companies was so scarce in those geographies for so long that they had too much power. Like the investors had way too much power, and I think it led to suboptimal results. Like you didn't have the ambition or the dreaming that you would get otherwise. You're kind of getting forced to cash flow break even as a 3-year-old company. Like that's not necessarily useful. And by the same token, I think it can swing too far the other way, right? And so I think it needs to be productive. But ultimately, like the relationship and the partnership with the founder is really based on like working closely together and trust. Because then I think you can all realize like, hey, we're pushing back or asking a question or pulling on something with the same objective of creating the biggest and best company that we can.
Yeah.
And I think that North Star alignment is really important.
To me, that's exactly what it comes down to is I think there's almost a positive selection bias. And I feel this all the time when meeting with a founder. There's, a group of founders that they just want to build the best damn company they can build, the one that has the most impact. They have the ambition to build something as great as they possibly can.
Yeah.
And those founders don't want someone to just come to the board meeting and clap. They want to know, what does great look like when they're hiring that next leader? We always think about pulling forward the future into the present. So you're not just optimizing for that next round, but you're really optimizing for like, what is the end state of this company and how do we build, a company that has the best fundamentals, escapes competition, has the culture that is going to have all the right checks and balances to really build something that endures. And so I find that I get most energized when we're pushing a little bit more. I think and this is one of the benefits of only making 1 or 2 investments a year is that we're more enmeshed. We're almost always involved in recruiting all the leaders. We know the founders really well, and we can start to see, okay, it looks like, remember that thing we heard in the back channel when we were hiring this person? I think it's starting to show up.
Yeah.
And like pulling forward some of those decisions. And when you make a decision 10% earlier and you make the hire 10% better, 10% faster, whatever it ends up being, those things compound. But oftentimes it means that we're advocating for something that we see as important, but not necessarily urgent before the founder themselves might otherwise have seen it, because there's so much else going on. And oftentimes the last thing you want to do when you're a founder is, think about adding something new to your plate, even though you know it's probably the right thing to do and it'll be the right investment and it'll help you 2 quarters from now, even if it's going to hurt you, the next 2 months. But that work means pushing a little bit.
Yeah.
And advocating a little bit. And we hope it ends up bending the curve a little bit more for these companies and leading to founders that want that.
One of your beliefs is that platform teams exist to scale the GP rather than get leverage to the founder.
Yeah.
And I found that curious because don't you want to add as much support as you can? You get as much leverage. You have assistants, you have Principal and Blake. And my take on that is that you believe the costs of having the platform team in terms of all the coordination or sort of how it excuses maybe the GP to spend less time outweighs the benefit of getting the extra support for the founder.
We are not a group of individuals that rest on our laurels. We're always, thinking of refounding benchmark, re-asking. You meet somebody who's a super talented talent leader, should we?
Yeah.
And I think what we realize is even if we had it, we wouldn't use it.
Yeah.
Because we actually love the work of, helping a founder, find that great sales leader. And we think that by being involved and ourselves as partners, getting the reps over and over and over again, that we ourselves get better at advising the founder on, the different types of engineering leaders or sales leaders or whatever it is, the network, the back channeling, whatever it is. And then of course, helping close. We want to be involved in that and fully integrated, and having a blind spot on any leader. I feel it. Like when I'm not involved with helping recruit one of the leaders, it feels to me almost like a little blind spot on the team that I just don't know that executive as well as I know the other ones. And having that really having the full experience with the founders, going through those recruiting calls together, I think ends up meaning a better relationship with the founder and our ability to be a better partner to the founder. And so if we had it, I think it would be the least used talent team. Yeah. And so, it's just not us.
Yeah.
I think so much of the value of a partnership with an entrepreneur happens in these very few moments a year. I think there's 2 or 3, it's not every month, where the entrepreneur's faced with a key decision, a crossroads of some kind, and what to do, what not to do, and how to change something. And by definition, that it's not an obvious answer. Of course, they've listened to the podcast and they've read the blog posts and they've looked at all the VC content marketing and they've read the books of the companies. But it's situation specific, right? It's market specific, it's company specific, it's personnel specific. And in those moments, the entrepreneur wants a sounding board, a partner to just navigate it, to try to make it, as Sarah said, a little bit better decision, right? And the question is what do you need to have in order to be a really effective sounding board in those moments? Because I think all the value comes from those moments. Yeah. And I think in order to be a really valuable sounding board in those moments, you just have to have the context. And you get the context by doing the work on an ongoing basis. And then in those moments, you can be really valuable as a sounding board, ask the right questions, help the entrepreneur have conviction or more conviction or confidence in the decision that they're making, and their recommendation. And as Sarah said, bend the curve. And so I think that's so much of how we tackle the job.
That's well said. I'm only 33, but even I've been amazed at how every few years there's just a new crop of entrepreneurs.
It's amazing.
Yeah. And kind of the board changes a bit. And I imagine that there's some percentage of deals for whom you guys have a unique perspective on that there aren't other firms competing for. And then there's some percentage of deals that you mentioned earlier, the 6 term sheets. They're very competitive. It's a very competitive venture landscape. And you mentioned that deal activity this year is up, but past few years has been down. And other firms, do more on content marketing and they do more deals. And so if these next crop of entrepreneurs are, hey, their deals were funded by X firm and that firm also just is more out there, how do you guys think about remaining the most relevant or the most top of mind or the most favored firm relative to your best peers?
It's a perpetual challenge. I mean,
Yeah.
there's no doubt about it. Like it's a perpetual challenge. There are 6 of us covering technology. Like that's tough. And it's a tall order. So I think that part's there. I think there are kind of maybe 2 comforting things in it. One is the entrepreneurs we do work with we have to deliver for them. And because there are not that many of them, we really have to deliver for them.
Yeah.
And we want to do that, and we're incented to do that, I guess is the point. And so I think in every competitive situation I've ever been in, it's the entrepreneurs that we work with that have been the biggest advocates that have tipped it in our favor every single time. And so I think we have to continue to foster that. The other part is you don't have to do all of the investments. Like you don't have to get every company. You don't have to do that. We aspire to be in the few that matter and that really turn into big, really special companies. But that isn't all of them. It's not most of them. It's not even a large percentage of them.
So you don't worry about seeing every deal. Some firms need to see everything and they can't miss anything, but
just can't.
Yeah, you're not structured that way.
Yeah, we just can't. Like it's just not possible.
Yeah.
What we have to do is really double down on selection.
Yeah, selection and giving the founders a great experience. In the last decade, we had a lot of, part of it was the sort of economic environment, but also we had this philosophy of blitzscaling, right? And particularly around sort of tech-enabled businesses that weren't necessarily software-first businesses. And there's dozens of them that raised tons of money. Some of them did well, some of them did less well. WeWork is one in your portfolio. I'm curious what you think the broader lessons are from these kind of tech-enabled businesses, and if you think venture will keep investing in them, or what do you think are the lessons that you've gone pretty deep in marketplaces, some of which are more software than others?
I think it was Bill who talked about how the more optimistic the looser the funding environment, the lower the gross margins are in the businesses that get funded. And certainly that is a dynamic that you see a lot or have seen a lot and is very different now. I think the other thing that I think about a lot is, we had a CEO of a big public company come in and he used this expression that I love, which is that bad breath is worse than no breath. And he was talking about account executives, basically, that so many companies during the last, 5+ years, 10 years, the last part of this bull run, have been so oriented towards growth. And it's been, the bar has been set by all these companies where everybody's aspiring to the 3x growth, the 4, like these numbers that end up meaning a few different things. They mean, and it's an orientation towards consuming more capital more quickly. It is a land grab orientation. And there's reasons to do a land grab. If you have a network effect, then you want to run fast. You want to, the stronger your network effect, the further ahead you are than the pack, the more dominant you become. And then it's just this self-fulfilling prophecy. And so there's certainly types of businesses for which that game is never going to change. And we love to play that game when we can do it. When the company, it's the right company for that type of orientation. But more often than not, you see this dynamic where people chase growth before the fundamentals are there, before they're able to support it with the right kind of organization, where it might actually, in kind of a classic marketplace, the idea of going after 15 cities very quickly, as opposed to really going deep and dominating one city. That orientation, I think, has really changed just because the funding environment, as interest rates go up, there's a very clear counterweight that happens on the company's ability to fund these early days. And I think it's going to be healthier for these companies long term in terms of, again, the bones and the DNA that they end up crafting. Sequoia
famously in, I believe, 1999 funded, was it Webvan?
Benchmark did too. It was a joint investment.
Okay. I say Memphis was the only to say that the company didn't work out according to hopes, but they thought, hey, still the right thesis, and maybe it's not the wrong time or the wrong company, but a decade and a half later, Instacart, and that one worked out. And I'm curious, going back to tech-enabled businesses, there's a lot of like real estate companies that have, raised as tech companies, not just real estate, but other kinds of companies. And I'm curious if you could imagine a similar story in the future of like, hey, was WeWork the right business model for venture scale? Just, not the right time or execution or whatever. I wonder if you guys are thinking about more discipline there, or actually, no, these are good businesses. Software is eating the rest of the world, and they make sense for us, just business models.
I could totally see. I say never say never.
Yeah.
We looked at a bull semen company this last week or the last couple of weeks.
Bull semen.
Bull semen, like literally bull semen, like semen from bulls.
In your personal time?
Right. Well, this is the right. It's the right question, which is like, it's I think this is like the amazing thing. Like, we never invested in a transportation company until we invested in Uber.
Right.
Like, we certainly didn't invest in a real estate company until we invested in WeWork. And, we've made very few hardware investments over the last 15 years, but we have an AI chip company called Cerebrus. And like, the point is that all these are capital intensive businesses, right? And so I'd say never. You're trying to like look for where the ground is shifting in the world, where there's a seam between incumbents, or something's changing that is going to create a crack of opportunity for a ingenious, scrappy founder to break through.
Yeah.
Like, that's what you're looking for, right? And like, sometimes it's just a granite wall and there's no crack, and that's a bad time, right? And maybe you can use a lot of money and get a lot of dynamite, but it depends how thick the granite is.
Yeah.
But other times there's like cracks, and if you look in the right way and you twist your head and you turn, you can kind of see a path through.
Yeah.
And, that's kind of what you're looking for. And those are the best, actually, in some ways, because it requires this like, cocked head looking sideways and the sun just right to see the path, which means a whole bunch of people won't see it.
Yeah.
And then sometimes there's just like a giant wide open path. And what happens in those cases is like, 20 people will see it, and like everyone will try to funnel through. And like a lot of times that just doesn't work for anybody. And so like so you it's a risk capital business, and you want to keep taking those shots. And I think Instacart like did work, and they seem to have done a really nice job.
Yeah, kudos to them.
Yeah, kudos to them. Just an incredible job executing in what is a tough market. And then the last thing I was going to say is, in markets like, it's particularly difficult when you go through like a ZIRP environment, right? Zero interest rates for a long time. Capital is raining down. There's new sources of capital. That's one thing we haven't talked about, which is there's all new sources of capital for venture, right? That outside of the kind of traditional endowments and foundations, you have a lot of sovereign wealth money and other things that have come into venture, family office, which will, some will pull back, but whatever. There was a lot of new capital. And then all of a sudden, like, it changes and interest rates start going up very quickly. And of course, you have a global pandemic, which completely changes office policies and whether people are in the office or not in the office. And so like, I would also say like, those are all like, they're not small complexities. Those are like societal changing things that have happened that make it particularly difficult in those kinds of businesses versus a traditional software business where your high gross margin, your primary cost is headcount. Like, those are much easier to adjust or turn the dials on, and especially in the recurring revenue business, right? And so some businesses are very forgiving to those types of macro changes, and others are not.
So what's the bull semen company do?
A super interesting company, amazing founders, solving a real problem. And it's kind of one of these ones where it's obviously way off the beaten path for us and not something we know a lot about, but you have to look.
What do you guys think about, when you think about the companies in your portfolio, like what are companies that scream like, this is a benchmark company? This is the type of investing that we want to be doing.
I think about Chainalysis, which was my first investment at Benchmark. What was so fun about that company is like, number one, it's kind of the classic hearing about a company, having a little bit of a thesis on the area, just kind of being intellectually really interested, provoked by what was happening in crypto, trying to figure out and think through. We talk a lot about this idea of, seeing the present clearly and looking at all the use cases and not really having a lot of clarity at that point on what the use cases were going to be in crypto beyond, what was happening at the time, which was store of value, raising money, more illegal things or, outside of, the normal legal framework, reaching out. And while everybody else at that point in time was thinking about ICOs and token investing and all these things, here we saw a company and a set of founders who saw something that other people didn't see. Michael, the CEO, had been at Kraken, one of the exchanges, and realized that if crypto was going to become a big thing, there was going to need to be a company that was going to partner both with the public sector and the private sector to get the public sector more comfortable with the private sector that was regulated, was touching fiat, to then participate in crypto as well. And so he saw something before other people did, brought in two incredible founders. And then we saw, both the early traction momentum and a possibility for this company to become the dominant player in their space, which is rare to find in software as a service companies. And it wasn't actually at the time that competitive of a deal. The company was over here, this exception to where all the momentum was in crypto at the time. And we got to partner, be the first board member, which is always our aspiration, to partner as early in the company's life as possible. Ideally, that first board member. And now it's been almost 6 years of partnering, and hopefully many more to come.
My first investment at Benchmark was Confluent, and it was the three founders, and they were like coming out of LinkedIn. They had started this open source project called Kafka. And that was it. And they were still employees. And so it was the initial round of financing and backing them. And it was a popular open source project, but people viewed it as kind of this like component that wasn't that important. That was a pipeline to something else. And the founders, led by Jay Krebs, painted this vision of why like that view was incomplete and it was actually going to be a much, much bigger thing. And here were the path that they were going to take to it. And it was like, going back to this like granite wall analogy, like, cock your head and look right through and here it is. Like, this is how it's going to go. And we have a lot of history with a lot of open source companies going back to Red Hat. It was like data infrastructure stuff that I like, and really authentic founders who just like lived and breathed the problem, the solution, had thought about it extensively. And so, what a cool project to get to be an investor in, participant in. And here we are now, I guess, 9 years. And, it's a $10 billion public company. So from nothing to that over the course of that time has been a spectacular journey. And I think like crawling through that crevice was something that they did astonishingly well.
Let's go deep on some sectors. I want to start with the consumer social. So you guys have done some of the more iconic consumer social companies of the past 20 years. I mentioned Snap, Instagram, others. And I remember we were talking a few years ago, Sarah, before the pandemic, that you're saying, hey, maybe there's an opportunity to disrupt some of these giants. People are bearish, but just maybe there's an opportunity. I'm curious for your reflections on what's happened. Let's say I went in a coma, right before the pandemic or right when we were chatting. What are your learnings or what happened in consumer social?
Would have been a good move to go into a coma.
Exactly.
I mean, look, like I think you and I talked about a post I wrote about participatory social and like this idea that I still believe in, and which is that so much of what social is today is this lean back experience where you kind of just feel bad about yourself.
Yeah.
It's one of the things I always loved about Pinterest, which was that it felt like this space you could go to online, which was rare and wouldn't make you feel bad about yourself. It was about dreaming and being inspired and thinking about a more creative life. But so much of social had become this space, and we see it in anxiety levels and depression levels of young people. Is like, it doesn't make people feel good about themselves. But what makes people feel good about themselves is participating, engaging with their friends, doing that work. And so, I still believe that there's going to be a company that comes along that maybe it starts off looking like a game, but will be about that connection that will emerge and will have the potential to disrupt these incumbents. But what happened instead in the last 4 or so years was you had these two things come together, which was this, real maximization of the algorithmic feed. So you're bringing in this kind of global maxima of content, personalized for each individual, which makes these experiences, so much more of what they already were. And then you also have the most addictive format that we've had in social, which is short video.
Yeah.
And so, of course, those two things come together with TikTok, which is just consumed minutes. And, Instagram is doing a really good job doing something that I've never seen another social company do, which is take the same atomic unit of another platform and establish it in their own and make it happen. But so they did it with stories, so they're doing it now with short video and reels. And it's just so addictive. I read this book, Dopamine Nation, went on a social fast. And the thing that I just found that most pulled you in was short form video. And it's everywhere. You can't get away from it. And it just means that the job of building a social network was always really hard, right? Like the list of companies that tried to do it and haven't succeeded is exceedingly long. And then that level of hardness just got turned all the way up. And so it's tough. But I think it's kind of back to looking for the exceptions and a little bit not giving up when everybody else has. Continue to be open-minded here, but it has not been easy.
There's always this hope that every new generation has its own
Yes.
social network. And so hopefully it's not just the same ones forever. But it seems like LinkedIn is just a professional network for it feels like you mentioned the graveyard of companies that have tried to compete with it. It feels like there's just no disrupting that. Is that something you believe, or is that something you've looked for?
I mean, certainly, I've seen a lot of companies that are, we're the mobile first, Gen Z first, LinkedIn. I think the companies that I've been more interested in are actually the marketplaces that have labor and are building a profile for those workers. So we have two companies in our portfolio that I can speak to. One is Instawork. I mean, this is just an incredible founder who has had an extraordinary level of grit because it was a marketplace for workers, for events. Imagine you're hosting an event and you need a bartender or the waiters, waitresses. They are a marketplace for that. It was pre-COVID. You can imagine this company was growing like crazy. COVID happened. Nothing. Really took the company down to the studs, launched in a new vertical, industrial warehouse use cases. And now, of course, it's doing incredibly well, having these two verticals going back to events and then the industrial use cases. And every worker, if you're a bartender, are you on LinkedIn? No. But you have a profile with Instawork, and the history of your work is on Instawork. The other example is a company called Medley. It's a marketplace for nurses. You're an outpatient surgical center, and somebody calls in sick. You need a nurse, pronto. You use Medley for that, and then you start realizing this is what happens with Instawork too, that instead of having the people there on staff, you can actually rely entirely on this new network of workers to fulfill all of the work that you have. And same thing, these nurses have profiles now on Medley that is a reflection of their history as a nurse. And so these kind of vertical networks that have emerged, I think there's going to continue to be other verticals. Real estate always seems like one of the obvious ones where you're going to see these types of networks form that way. And they never look like the last generation, right? This is not a network. It didn't start with a network and then become recruiting. It kind of started with the human capital and then became a network. Who knows what the next generation will look like?
The question I've been curious about for many years now, but I've never figured out the right solution for is how you bring reputation online. We've done it with certain categories like Rate My Professor, things like that. But reputation is so valuable. I mean, reference checks that we do is so redundant on so many levels. And at the same time, it also feels like information that just doesn't want to be on the internet or something. But I think at some point, someone's going to figure out an elegant way to represent that, because it seems like one of the great scarcities in this new AI era is information that's in people's heads that's not on the internet.
Yes. Rich Barden was the CEO of many
Glassdoor,
incredible
Expedia.
companies, just in Expedia. Zillow was a venture partner with Benchmark. And one of the things he always talks about is, the data that is in the shadows, whether it's a data system that's already kind of exists, that's structured, and you can bring it online or in our brains, and you can bring it into public domain, Glassdoor being an example of that, another company that he helped found. That is always a recipe for really a big opportunity.
Yeah. It feels like, we've been talking about different eras, internet era, mobile era, we had a bit of a crypto, we're in AI, we'll get to that. It feels like different eras, values accrue differently between incumbents and startups. It feels like internet era produced, literal $trillion companies. Mobile era, hasn't been as long, so maybe they'll get that big, but it feels like they won't. It feels like they, produce some epic companies. We've talked about some of them, but it feels like it was an extension of the internet. It actually enabled the internet companies to get to $1 trillion. And it feels like that's sort of the consensus on AI. That in some ways it feels like an extension of something that will continue to compound, that there will be big companies, but the biggest gains will be reaped by the incumbents. Is that an accurate read, or do you share that read, or how would you edit that characterization?
I think we don't know. I think it's early. Like, I think in the AI world, it feels like there's kind of three distinct things that are happening, and I'm sure many others, but one is the model piece, right? And the foundational models and everything else. And I think that's an area where there's a few organizations who are spending gobs of money, and 9 months later, there are open source alternatives that are almost as good, and maybe even better in specific applications, and like were developed by, 3 guys, a dog, and a couple $1 million. And so, like, it's kind of an astonishing element, and it's such a tremendously depreciating asset, like that, the foundational models. There's a lot of cool work happening there. We've always been long open source. I think that continues to be really interesting, and there'll be a lot of cool stuff happening there. Second part is something that Sarah's talked about before, which is like there's new vertical companies where they're selling the work. A lot of it's selling entry-level white-collar jobs, whether it's, medical transcription or paralegal work or assistants or analysts, and so forth. LLMs in particular are really good at that. There are new companies that are developing to do that. I think there's a real question as to the durability or defensibility of those companies, but they're super interesting. They're getting real traction. They're solving real problems. So, I think that's the second category. And then third is what you mentioned, which is they're incumbents, whether it's, GitHub with Autopilot or Copilot, or Microsoft introducing the writing capabilities into the Office platform and so forth, where there is enhancement to an incumbent base product and distribution, which seems to work really, really well. And I think in that third category, AI has the ability to actually reshuffle the deck. There's some hierarchy of those products and those companies, and you could totally imagine the 4th or 5th place player or the startup who kind of comes in with better AI or a more AI-centric approach, leapfrogging the winner just because it becomes so necessary. And I think you're going to see a lot happening there. I think we're watching all three, and we're in it. And where does value accrue? Are we going to see some breakout companies in that second category in those vertical applications? It feels like we will. It's hard to decipher right now, but I think we're meeting them all and trying to understand that and develop a conviction one way or another. And then the same kind of thing with the incumbents and with the models. Maybe I'm a little more skeptical right now. It feels like amazing technology, and I'm excited to see open source continue to win. But there's a lot of work to do to turn those into monetizable opportunities.
Oftentimes, the first wave of companies that emerge can create a head fake in a way for people and how they analyze the industry. And so it is natural for the first wave of companies to kind of continue the mental model that we've had for the prior generation. And I love this saying, I forget who said it, which is the startup has to race to get to distribution before the incumbent gets to innovation.
Yeah.
And certainly, a lot of what has happened is that you've seen startups that saw GPT-3, took advantage of it, and ran really quickly. But man, the incumbents are really good at innovating right now. And so they caught up very, very quickly. And that created this kind of sentiment in the ecosystem of like, oh, the incumbents are going to be the main beneficiaries. But now we're starting to see this next generation. And I think a lot about what Erik was talking about with work as an example, where you always have to think about what the jujitsu move is going to be when you go against the incumbents. Like, in marketplaces, actually, it doesn't really matter how big, the incumbent is. It's always like, how much better are you at making the customer happy than the incumbent can? And what's a jujitsu move here? Like, certainly there's like new surface area, right? Like going after verticals that wouldn't have otherwise supported a software company that had to sell a productivity lift, 10%, 15%, whatever, trying to make that business model work versus a company that's actually just selling work, which is a 95% productivity improvement. That's like very disruptive. It's new surface area that I really believe is going to create a new generation of companies. And then when you think about the incumbents, Erik's third category, well, where are they vulnerable? They're vulnerable in that most of them charge per seat. And that is a real innovator's dilemma. And so, yes, they can, make each of their seats more productive, give them superpowers, but it might be that a company comes along and doesn't need to charge by seat, has a different way of thinking about what they're building, the value proposition, how they price it to the customer that is disruptive. Adam D'Angelo, the CEO of Cora, another company another founder we get to work with, talked about this as the next industrial revolution. And it really feels that way. But there's something unfair with like, okay, if you're $1 trillion company, and you leverage AI in order to build 10% more market cap, that's a lot of money. And so there's kind of a little bit that dynamic that we all face. But when you're thinking about it from where we are, there's going to be some really important companies that get built.
Yeah. It is interesting. You mentioned GitHub. GitHub was a company that had very low revenue when it sold. Is that accurate?
I think it had a couple $100 million, 300 million.
Really?
Maybe.
Yeah, not too shabby.
But I just saw Hugging Face raise this big round. It feels like they have pretty low revenue. Like, it feels like there's some companies that raise very high valuations that have some real value there, have really strong community with strong data, but just haven't figured out monetization. And it feels like, I don't know if they're built to sell to incumbents, but it feels like it's unclear how they become independent, massive businesses.
There's definitely a hype cycle in AI right now. And so I think that's just the reality. It always happens. It's fine. But here's the thing about hype cycles. Normally, in one of these hype cycles, there are a handful of companies that like you almost could pay whatever and it still works as an investment. Like there are some like amazing things. And part of the reason there's hype and like all these companies get marked up at these incredible prices is because everyone's looking for them. Everyone's looking for one of those companies that is going to be so special. And so it turns out if you overpay for a company that ends up being $1 trillion company or $100 billion company, it doesn't really matter, right? That's fine. And there's always a lot to figure out. Like people forget the early days of Google, like they didn't have monetization. They had amazing growth, right? In terms of they were stealing share. I'm talking about like 99, 2000, I think 2001 even. They had just stealing tremendous share from other search engines because it was a better product. And they were really unclear on how to monetize it. I think at one point they were actually worried that they were going to run out of money because they were spending all their money on data center costs, like to keep it up. And so you can figure it out. Like is my point.
If you have enduring value.
If you have enduring value and you have something that is there, it gives you the license or the opportunity to figure it out. It gives you the freedom to figure it out with some period of time. And, that was always one of the big pushbacks on social networks, right? For a long time, if you remember, it's like, how are these social networks going to ever make money? Are they ever going to make money? Do they have a business model? Blah, blah, blah. And then like, here we have Facebook, which is what, 500 billion, 600 billion right now. And so like, it turns out like it can work and can figure them out.
What we've seen in this era so far is that companies can grow insanely fast or much quicker, can get attention, quicker, but they can also lose that quicker as well. And there's this whole sort of meme at this point of like the just wrapper around GPT, or people. I think Jasper is an example, a company that grew super quick, and maybe people are unsure about at the moment. How do you think about? I think you wrote something to this effect, Sarah, of like, what are the types of companies that are going to have enduring value or truly defensible?
When you think about most SaaS companies, the reality is that very few of them have had a tech moat, right? Sometimes, occasionally, I know with Amplitude as an example, like they did work on like the core database to like deliver the service in a way that wouldn't have been cost prohibitive for them to do it. But like very rarely are these companies actually, really about some special IP. It's always about what is the advantage of scale that you get, the getting at the market faster, with a better product, the work that you do as you build more and more of the features that people need so that you can deliver more and more value to the customer. And I think certainly you see that a lot, even with Jasper, of, the work that they do, fine-tuning, getting more enterprise ready. Like these things, you kind of take it for granted, but it's like real work that has to happen in these companies. But, one of the things that I think about a lot also is there something that as you build it, you're building something else that has accruing value for the company, whether that's the data set that you're building that lets you fine tune and make kind of the value proposition stronger and stronger, whether you're creating a new system of record for something, whether there's a new data asset that you're creating that's almost an exhaust from doing the core work, but is itself valuable. And there's also just like the last thing, which is the core enterprise software work that sometimes has to happen of like building the functionality that makes it easier for these, companies to grow in an organization. And so, the thing that I worry more about is trying to get distribution before the incumbent gets innovation. That just seems, there's a lot of companies that were, a new document type that you could use to, use a large language model to help you write. And then Notion adds, something exactly like that, where you already are. It's really, really hard to compete with that.
Yeah.
You're not trying to do that race against innovation for the incumbent. You're building something new that is a new surface area. That feels like the really important thing to focus on.
I think the nature of moats are much more complex than they seem on the surface, I think. And I'll pick a controversial company, Tesla. And I think one of the things that's interesting, so a large car manufacturer CEO said this, an incumbent car manufacturer, internal combustion engine one, said like, it's like, what's the moat for one of those companies? And his view was the moat was like how they build a car. And his primary concern wasn't like electric versus like this or like that. It was like, did Tesla figure out a better way to build a car? And what was meant by that was like everything, like the unibody design, the biggest casting machines in the world, the emphasis on like software battery development, like, and how do you manage that? And his point was like every single thing that they had done over the last 100 years was built around one way of building a car. Right? And an assembly line where you do things a certain way and you go this way. And Tesla may have figured out a better way to build a car. Like that's the moat. And that's the thing that has like shifted. We're trying to figure it out. Like where is the moat on a lot of these AI companies and how do you think about it? But I think it might be more hidden and under layers or really like more convoluted or more complex maybe than it seems on the surface.
Say more about where you think people kind of misunderstand moats in general. Is it that they see them out
like
there?
You hear like these kind of simplistic things, which are like data is the new oil and data is the moat. It's like, is it? Like, okay, like maybe, or like, one that's popular around the AI companies right now is like access to compute or whatever. It's like, is it? Like, I don't know. And those feel like things which are, more transient or there are ways. I think what like data, take data as an example, like people have very consistently figured out ways around that. And I'm sure I'm wrong about some other case. Like there's some case where there is a huge proprietary data set that's really valuable, like, Rentec, right? Renaissance Technologies, like they have built, I think their business, they would say as a fund, right, an investment house, is their data moat, which they have built over however many years and really took time to develop. But like in general, I don't know that most of these companies who think they have a data moat. Like, I don't think there's that much value in their proprietary data. It turns out, like, yeah, they have their data and someone else has data that's available on the internet, and it's basically as good.
So they're defensible for other reasons, or they're not defensible?
Yeah, it seems like. I mean, that seems like it, right? And so I think you kind of keep going through these things and you see examples like that where you can kind of come at it from a different direction. Let's take another example, just because we're talking about these really interesting businesses. Is like forever people thought, like with Netflix, like their back catalog was the moat.
Mhm.
Yeah.
It changes.
That's really interesting. Venture capital firms don't have data moats.
No, we do not have data moats. we
You benefit from strong brand moat, like long feedback loops. So brand becomes a moat, but
yeah, I think brand is a moat, and then like you just have to wake up every morning running, with absolute reckless abandon hustle, to maintain that.
Peter said that the day that I Peter don't want to cold email a founder or think I'm too good to do that is the day where I stop being a good VC or something like that.
It's just it takes
There
that.
really is something to that.
Okay, we talked a bit about AI. I want to talk about crypto as well. Here's my read from the outside on benchmark crypto. You guys made some great, you made some money, made some great bets, chain analysis, Bitcoin early, Zappo, I'm sure.
So rare.
Yeah.
Global elimination.
I'm sure, a few others, but relative to your peers, I don't want to say you sat out, but you didn't go all in the same way. You were disciplined, relatively disciplined. And the firms that lost the most and maybe, won the most feel like they were just more comfortable YOLOing. And it feels like that's not as much in the benchmark DNA because you're more fundamentally more sophisticated. You're more going to do the thing that guaranteed does well versus willing to take these kind of like bet it all type thing. Is that an unfair read? I'm sure part of it's YOLOing, but also part of it is it's just kind of like a different kind of fundamentals, which is more like what are other buyers going to do, like gonna do, or more about like even NFTs is such a status driven thing, more like sort of awareness of the markets and just like a different kind of investing than fundamental venture investing.
Yeah, I think that's what it comes down to. Is actually like the way I think of it is like there was a class of companies playing in the crypto space where they were founders that believed that company building was going to be really important.
Yeah.
They were founders that were excited about the technology that, was getting more and more mature around blockchains and crypto generally, but also recognize, are oriented towards building an enduring company, doing the company building.
Yeah.
I think we have a very large percentage of those companies. The founders of Sorare are just incredible. And from the very beginning, even though they were participating in this NFT world that had a lot of hype around it, they were very oriented on finding a partner to help them build a really enduring company. Same thing with Global Illumination, which we just sold to OpenAI, and then Chainalysis, Wensis with Zappo.
Yeah.
And so those companies, those founders were very oriented towards those types of businesses. Then there was another class of company, which is where, the crypto-focused funds ended up really orienting towards, that were very focused on, kind of the example of Uniswap of like, a company that built extraordinary amount of value with a super, super small team because they were able to use tokens and token economics in order to not need to do the company building and to create the right incentives to enable and facilitate that ecosystem. There were great examples of companies there, Uniswap being one of them. There are many more. And there were a lot of companies, kind of to the earlier conversation with Erik, that it felt like a very, very short-term orientation. I felt a little bit like it was, the culture that kind of got set in crypto with ICOs, where you write the white paper, you raise a lot of money, and then you'll figure out how to build the thing.
Yeah.
And like the founders at that point, they don't even need to be around the hoop because they've already got their tokens from the ICO raise. That permeated so much of the culture of building in crypto. It permeated how people thought about NFTs. And that just isn't our orientation. Like, it's a game that a lot of people were able to play extraordinarily well, and like, kudos to them. But like, that just isn't who we are. Like, if we wanted, there are ways that benchmark we could all make more money, right? Like, we were joking before we started about the benchmark growth fund, like,
wealth management.
We could, wealth management, all those things. Like, there are always those types of opportunities. And certainly that era felt like it for a while. I joked once that I felt like I was a professional basketball player and I took a rocket ship to Mars and I like tried to shoot a hoop and then the ball just like floated away. Like, there was so much that wasn't who we are and the game that we want to play, which is that building enduring value, really partnering with the founder who wants to do that. And that's why we're here.
Yeah.
Is doing that work and that type of partnership. And that just felt very different. And so I think of the companies that fit the mold of partnership that we want, we were there.
Yeah.
We were in that arena. But the other thing, people did a lot of great investing, made a lot of money. That just wasn't, that type of orientation wasn't our thing.
We're all in the arena just trying stuff. Some will work out.
Yeah, I can't believe I said arena.
Yeah, exactly. Let's talk about healthcare for a minute. I was wondering if things have changed because we talked a few years ago. Your wife is a longtime healthcare entrepreneur and investor, and you were bearish about it after going a little bit deeper as a firm about it. Just it's so hard, et cetera. Nothing changed. Not looking at on there.
Healthcare, health tech it's a really humbling space for a founder. And like, there's a number, I met with a founder just the other day, so super talented team that, one of these, they had an idea using AI for a value proposition that makes so much sense. And then you start to ask the question of like, well, who's going to pay? And where are the incentives going to come from for that to happen? And you're just like, oh, these poor guys. Like I introduced them actually to a friend of ours, Malay. Because I was like, Malay, like these are super smart guys. Yeah. But they need help guiding the topology of healthcare and just the incredible incentives that are so not what you would rationally design if you had a blank sheet of paper.
Yeah.
And so I think it's one of those spaces. There's some spaces in venture and what we do where I joke, you have to marry them, you can't date them.
Yeah.
I actually felt kind of crypto token world was one of those spaces where if you try to date it, it's going to be really difficult. Yeah. It's so specialized. I think healthcare is one of those too, where it's a really hard one to date because you just have to have that mental map in your mind of all the incentives and all the different players and how it all fits together. And it's really tricky to be surfacey there.
To take the contrarian view.
Please.
There are emerging areas. Mm-hmm. You're on the board of Medley, Nurse Marketplace. I work with Benchling and a company called Acuity MD, which serves the medical device companies. And so like there are these areas that are not directly hospitals and patient care.
Yeah.
And the weird triumvirate of insurance, patients and providers, and like everything that goes on between them and the weird incentives between them. But actually all of these other areas around them, which really do contribute to a better patient experience, better medicines, better patient experience through better medical devices or better nurses, better drugs that are important. There is a lot of interesting innovation happening. And we're actually bizarrely invested in them.
That's true.
And actually all those companies are doing well, which is kind of interesting too. And so I think there's this other dynamic, which is just like maybe the way to tackle the industry isn't to mess with this like triumvirate, which is at the core of it, or have to integrate with the EMR, which is, controlled by one company largely that has like literally no incentive to do anything except increase the percentage of GDP. that we spend on healthcare in the country. Like, it's just like maybe we just have to come at it like this away, you know? Totally. And I think we'll continue to see those, and excited to see those companies, because there is a lot of spend there. There's a lot of waste there. There's a lot of room for innovation. And so it's just like finding the angle of attack.
I appreciate the light disagreement there. Is that as a segue to when you guys are debating sort of the refounding of the firm? What are the debates that keep coming up, or what are the conversations or questions that you guys are asking yourself when you think about, hey, you know, I know we've said we're going to do this for so long, but is this something we should consider? What are the questions?
Probably the one that I think about the most, in part because I grew up in the industry this way. You know, I started my career in venture as an analyst at Bessemer. And so lowest rung of the ladder, you know, cold calling founders, which was kind of an early idea. You know, Jeremy Levine started that program at Bessemer and now has become, you know, the default in a way. Like these other firms, you know, as we talked about earlier, they see 100% of the companies that are getting founded or funded. And one of the conversations always, we have chosen thus far to be really the 6 general partners. We have, you know, Blake, who's incredible as a principal. I think we've had maybe 5 Blakes in Benchmark's, you know, 25 plus year history. And so, you know, the paranoia that I certainly have all the time is there is going to be that founder whom mistakes our lack of outreach for a lack of interest. Yeah. We are constrained by the fact that we have 6 people. And other firms have dozens of people who are reaching out to seed funds, you know, cold calling the founders. And so you know, it's very easy for a founder then to kind of look at their inbox and decide whom they're going to raise from based on their inbox. Yeah. I actually had a funny experience with a friend of mine who's a YC founder. And he was telling me, he's like, my process, you know, it's just not moving that well. And I was like, well, tell me who you're talking to. This was like pre-revenue company. And I looked at his list and it was all these like multi-stage venture firms who had reached out to him. I'm like, oh my God, like, it's like, it's a wrong signal, but a lot of people make that mistake. And so, you know, there is a corresponding, you know, the trade-off, of course, to having more people at Benchmark besides the GPs. One of the biggest ones is just, does it end up atomizing our attention away from the collaboration that we have with each other? And there are many, many other things to think about, but that is certainly when you ask me where I'm most paranoid, I want to make sure I'm seeing the best companies that I can possibly see, getting to meet those founders. Yeah. People tell stories about us, you know, they move whatever. They're going to want a lower price, or they're going to be slow or whatever. Like, you know, people tell these stories. They only say yes once or twice. Yeah. Don't, you know, whatever it is. We need to work against that all the time to meet those founders. And other firms have developed machinery around it that we don't have. Totally. And that's a trade-off.
And it's interesting because, if in a competitive market, you don't want to be, no one wants to be like a worse version of other firms playing their game. You want to play your game to the max.
100%.
And so, you could have a little bit of platform team, but these firms have massive, so no one's ever going to compete on that level. But what they're not going to compete with you on is GP time and attention and focus. And so maximizing that.
It's a great, like, you know, one of the trade-offs is like when, you know, we cold DM people all the time, right? Or, you know, do the kind of the first call. That is us reaching out. There's no army of people who are doing it. It is us, and like there's no person when we engage with a company. There's no person to whom I say, oh, like reach out to these other companies, or do these diligence calls, or go through the spreadsheet if there's a spreadsheet. There rarely is. Yeah. But that's us, and again, we think that leads to a better experience for the founder. It leads to better decisions by us. But there are trade-offs to everything.
Yeah. Benchmark does the work. That's a great place to wrap. Erik and Sarah, thanks so much for coming on the podcast.
Thank you for having us.
Yeah.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you like the episode, please leave a review in the Apple Store or rate us on Spotify. Hey everyone, Erik here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at erikaturpentine.co. That's ERIK at turpentine.co, and let's partner together.